What's going on, guys? It's David Piatek, and today we're going over the September ICE Mortgage Monitor report, which accounts for 99% of the housing data out there. There's a lot of fear mongering that's going on out there, so this report breaks down what's actually happening in the market so you get an actual understanding of what's happening so you can make a decision for yourself. Some of the key highlights I'm going to talk about is that affordability reaches its best level since early 2023, and borrower profiles reflect improved financial stability. And we're also going to be talking about flood insurance because it is a very relevant topic right now, especially with the government shutdown happening as of this video. But we're just going to talk about in general what are all the implications that happen with folks that are just have insurance or don't have insurance, or this lapse in insurance that's going to happen. So let's just dive right into kind of what's happening. So I know there's a lot of data on these slides, so I'm going to share it both in the description down below. And if you guys are looking to use your VA loan or get a mortgage, I'm a loan officer and happy to help you with that. You can schedule a call with me down in the description below. And then that way you get all this expertise you watch on the channel on VA housing education for yourself and your family. So I'm going to highlight what's going on here. So while mortgage delinquencies typically face very little seasonal pressure from July to August 2025 ended on a Sunday, which created a bump in delinquencies as processing of last day payments rolled into September. So people being late on those payments. Another important thing is that delinquencies are up 16 basis points. Now, that's the number of borrowers a single payment past due has increased to 62,000 people right now have missed their first payment. Now, 90 plus days loans that are past due but not in foreclosure increased 3.5% in July. So that's kind of like on their way into going into foreclosure. We also see a drop of foreclosure starts month over month of down 10.1%, which is very positive. Loans in active foreclosure increased 23,000 year over year, which means below pre-pandemic levels, surprisingly. We also see a drop of 1.4% in prepayment activity. So that's the single monthly mortality edged down to 0.66 as rates held steady in July. Prepayments remain up almost 6% from a year ago. So that's like prepaying your mortgage. So I'm going to highlight a lot of good stuff here, but just note there's just so much data in this. Now, national delinquency rate of first lien mortgages. So this is kind of what they were talking about a little bit, what we just covered, is that you have the blue line is the delinquency rate. The lighter line is the 2020 to 2025 average of of delinquency of first mortgages. So as you see, right now we're trending lower than the average of 2020 to 2025, which in a way is positive, but foreclosures are also pretty high. This also shows you non-current rate of first lien borrowers based on loan product. This is very important to understand. The dark black line is FHA. The blue line is VA. The light gray line, that's like general government loans, and then you have portfolio loans as well. So GSEs will be like, that's going to be your Fannie Freddie loan products that exist. So obviously they do have the lowest foreclosure rate or missed first payment out of any of the loan products, including portfolio. But we'll see that FHA has definitely been on the rise, which could be an opportunity for folks out there to take advantage of the current housing market, right? And foreclosures, typically when think of 2008, 2009, you have all these loans that went into foreclosure and they kind of were they dragged out because there was so many of these foreclosures that were happening. Over time during that time, values continued to go down and people were just kind of at the sideline waiting to pick those up. In today's time, I think it's harder to do that because you have the housing demand is there. So if a property is listed for a decent price point given for that area, and decent is whatever you want it to be, you're going to have somebody buy it at some point, right? So if the price starts too high, it continues to go down until they have someone that bites, or a market may shift, or interest rates may shift. So that's why it's a little bit tricky on that sense. But you could just be on the lookout to pick up an FHA loan. And also, just a side note, remember, FHA loans, VA loans, and USDA loans are assumable. So if somebody may be facing financial hardship, you may be able to step in and assume their home loan, which could be a pretty good option for you. All right, now let's talk about mortgage performance. So serious delinquency loans 90 plus past due, but not in foreclosure, rose 16,000 in August and up 32,000 from the same time last year. The share of past due mortgages that are either seriously delinquent, 23%, or active foreclosure, 10%, remained steady. So that's positive. Foreclosure starts is largely driven by the resumption of VA foreclosure activity. And then I know right now that they are still waiting to implement the foreclosure assistance program for veterans, which hopefully will be out by the end of the year. So stay tuned. We'll definitely be doing a video for that. FHA foreclosure starts have also risen annually in each of the past 6 months. That's, we see FHA loans kind of lead that. They definitely allow for lower credit scores and higher debt to income ratios, which may be a factor to that, but it's also a piece of affordable housing. Let me show you guys this screen here because it's a little bit tricky because it'll pop down for me before I could even get to it. Now, it won't let me show you guys this part. So let's go over the next section here, which is going to be the interest rate and refinance demand. So one thing that we've talked about before, and you guys a lot of people anticipated that, well, if the Fed drops the rate, mortgage rates are going to go down. And so the opposite happened. And this is something that we see often. Okay, this isn't the first time. It happens every time this happens. And people are like still thinking of the COVID timeframe. And let me explain what that means. So during COVID, what happened was, right, when every time the Fed would drop the Fed funds rate, people would see interest rates would drop. And that was unusual because historically, every time the Fed drops the interest rates, people typically pull money out of bonds, put them into the stock market historically. So then in order to bring people back to the bond market, rates need to go up, right? And then plus if the Fed is dropping the rate, that means there's economic trouble. So again, we're kind of going in this vicious circle, and the Fed funds rate is more for short-term debt like car loans, credit cards, and things like that, HELOCs. That won't necessarily affect the 30-year mortgage. But what we've seen over the last couple of times is that every time they're anticipated or a high confidence they're going to drop the rates, you see mortgage rates go down before the drop. So like a 2-3 weeks before the drop, then when they make the announcement, it drops and then rates go up. It's just how it works, because back at COVID time, every time they dropped the Fed funds rate, the government was buying bonds. Okay, so they were basically artificially held low because otherwise rates would be probably 10%. There was a period of time when COVID got announced that rates were just off the charts, like literally off the charts. Like you couldn't even price loans for a period of time. And when they did come back, the rates were just astronomical until they came up with a plan, and then we kind of moved forward from there. So keep that in mind and do this. So yeah, so over the last month, we saw rates go down, and then they went back up, so as they indicate here. Another thing that I want to point out is that as of September 22nd, right, so this is a couple weeks ago, prices on ICE conforming 30-year mortgage locked index suggested the market is pricing rates near 6.25% by December and 6.125 by March of 2026. So if you look at the previous section, right, sometimes you're going to be able to see that rates dip down to 6.125 on September 16th. Again, this is like based on ICE mortgage markets locking stuff. So it's not too far from that. So do we really see rates changing too much? I don't think so. I think that markets right now have somewhat stabilized until the next Fed meeting if they lower the interest rate. But that's the note here at the bottom, is markets still anticipate at least 1 to 2 additional quarter cuts to the Fed funds rate this year. So we'll see what happens in total. Right? This just kind of shows you the yield spread, the premium spread between the two. So you see it here in the black line is the 10-year Treasury, and then you're going to see in the blue line where the conforming rates are. So again, there could be some opportunity for folks that are maybe holding out or just refinance or just bought a home to be able to refinance a little bit later. And as usual and as clockwork, every time you wait to purchase a home, typically values go up, and then you're fighting that, hey, rates have dropped down, and again, people are back in the market. So just be aware that as you go through this home buying journey. Next, we're going to talk about interest. So again, interest rates and refinance demand. So refinance has increased 80% over the last 4 weeks. Now, right now, they've kind of tapered off for that. Roughly about 31 million people were able to reduce their interest rate, or able to reduce their interest rate at least 75 basis points, so 0.75%, which is very positive. I'm going to show you guys this chart here of people that are. Let me zoom out just a little bit. So number of in the money mortgages under various 30-year rate year rates. So people basically being able to save 0.75% on their interest rate, which I believe averages out about $280 a month. So as you see, the lower the interest rate goes, the more people are able to refinance. Now, if my memory serves me correct, prior to COVID, right? So leading up to that, rates I believe were like right around the upper 4s, 5%, right? So that was in a normal, I would say considered normal market with air quotes. So can we see that happen again? Potentially. If that were to happen, then a lot of people would be able to refinance. So look at 4.5% interest rate, 15.2 million people would be able to take advantage of that and lower their rates. And so a lot of people that already owned homes during when COVID hit, they were able to take advantage of the lower interest rates. People that were coming into the market blew up the home values, right? They skyrocketed. So they were paying a lot more. And a lot of people saw mass appreciation and lower payments, which is very positive. But that's why waiting isn't necessarily an advantage because of those adjustments. Now, we're seeing price softening, so meaning prices going down. So that might be an opportunity to be able to cash in on that. Let's see if I got anything on this price. So yeah, I went over the whole thing, plus I listened in on the whole video. So I mentioned a little bit earlier that we see affordability and also financial picture has been increased, which is very positive. So lower rates have also improved affordability. The average debt to income ratio for rate and term refinances dropped from 34.1%, the lowest level since March of 2022. This is the average credit score for people refinancing, right? So, and again, why this is relevant for if you're watching this is if you have, I'm gonna just say, in air quotes, bad credit, right? Because it could range based on the loan product. But if you're typically under 600, you're not going to get the best financing terms, okay? So if you may be at an interest rate right now where you see market rates a 0.5% or 1% or 1.5% lower than what you have, but if you're not able to get those because you don't have the credit. So I always tell folks is that work on your credit first to improve your financial buying power or refinancing, because then it gives you bigger savings on the monthly basis. Okay, so that's why it's so important to maintain and have good credit. Now, this is an interesting piece that I wanted to share with you guys. So average debt to income among rate and term refinance rate lock. So this kind of gives you a history from 2019 to where it stands today. So that's why I was saying affordability is kind of at its best. What we see over the last, since 2022, right, we see average DTIs of 35 to 38%, right? So not a big swing. So we were talking about 3% change in payments. People's incomes have gone up. So when people talk about affordability and kind of looking at the general market, it doesn't seem that it's affecting like from the data point, right? Now, compared to, let's say, 2019, where average debt to income ratio is 30%. That's much better than getting close to 40%, definitely. But those are things that you need to consider when you're going through that home buying journey. And so that's why we talked about the 2.5 years affordability, national payment to income ratio. Okay, so this is going to talk about not only your like the debt to income, but national payment of your mortgage to what you make. Okay. Then here on the right, it's going to show you what the interest rate is. Here it's going to show you in the blue line the Freddie 30-year fixed mortgage rate. And then the black line is going to be the payment to income ratio. Okay. So as you see during the 97, the rate was much higher and payment was lower, and then it kind of flipped, and it hasn't gone down since then. Affordability, home affordability comparison by market. This is a great one because, and again, this is so small in print, and I'm sorry about that. But what I encourage you to do is take a download and take a look at it, because it gives you different markets and metrics of how affordability has been affected. And obviously, look at California, huge effect on those folks because home values have just skyrocketed. Same thing with Florida. We see a lot of that. And then in the Upper East Side, the Midwest has been somewhat, relatively stable, which I think is positive. And this is why, if you have the flexibility to live anywhere, you really need to do your homework. Now, for the housing market, still we have fewer listings and increase in delistings by sellers amid falling home prices. So basically, what's happening is that sellers are deciding to unlist their properties and keep their homes because home values have been dropping, which, again, when they do that, they restrict supply. Now we're looking at a demand piece, but it's not like that everywhere. It definitely fluctuates, and I highly encourage you to do your own research on your market. So as of 2025, we see, so look at this. So December 2018, we have a surplus, and then we have a deficit of inventory. And that's still true for majority of the country, but there's definitely a couple of markets that it is affecting. Inventory is still up over last year in nearly all markets. And that's what they were saying, that by end of this year, beginning of next year, we should be back to a pre-pandemic inventory level. And so we have these pricing adjustments that are happening right now. And some people are like, I can't believe the home values are going down. But what would you think would have happened if you have more supply, right, on the market? And interest rates have kind of been somewhat steady. And if you think about it, last year has actually been decent because prior to that, rates were in the 7-8%. So it's still better. And affordability has kind of somewhat adjusted. And as we're talking about it, right, last 2.5 years, we have the highest affordability point right now. So those are things that you want to take a look at. And as you go into, let's say, the fall market, if you live up north, it might be an advantage because typically the markets slow down and we have seasonal adjustments, which isn't a bad thing. And a lot of people will harp on that as like, oh, it's super negative that home values are adjusting. Like, yeah, winter's coming. So people are not as active. And then you have the holidays and all that other stuff that comes with it. So don't be fooled by that. Remember, it's not what the market's doing. Okay. That when you look at housing, don't worry about that. Worry about, can you afford today? Right? And if you can't afford today, anticipate that home values will go up, down in the future. So you might have to look at other areas that are more affordable for where you want to be, right? If you have a VA disability, then look at the counties and the states, what benefits they offer, and see if they've been changing, because they definitely change over time. All right, so I wanted to show this chart, but it is so much, it's so data rich, and it won't let me kind of pull it up on here. So we'll with that being said, I would definitely encourage you to check out the ICE Mortgage Monitor report. It comes out every month. We do a video on it. I just kind of go over and highlight some of the important things that are happening in the real estate market, because it's not all doom and gloom like people make it out to be. There's a lot of opportunities to become a homeowner, and sometimes shifting the market that you're in is gonna help you the most. So please make sure you hit the like and subscribe button and check out the channel. There's tons of videos around using the VA home loan, how you can leverage it, leveraging debt, how to build your credit, and just take control of your finances. And I'll catch you guys on the next video.